everybody. Welcome to Friday, another Talk Money with Tom show today. I want to thank you very much for joining us. We are here to help you try to improve your financial portion of your retirement. Whether you're retired already or looking forward to retirement, I think we'll have a lot of things that all of you can use. And we do that through answering your questions. So you can send in those questions at any time. Ask Tom at talkmoneywithtom.com. You can put them into the chat live here, and we'll try to answer them, as we go. And of course, we have this channel there because we believe that there's kind of a missing group of information here about retirement planning, asset management, and tax planning during your retirement years. And so I think we have over 1,500 videos now, so you can go to the channel, you can subscribe to the channel, you can hit the little bell if you want to get notified when we put new content out. I do a video every single day on what happened with the market that we put out also. And of course, you can always meet with us. You can meet with Ethan and I if you'd like. There's an appointment button on our website. It looks just like that. Go up in the corner, hit that. Our schedule's live. Pick a time, 30 minutes to meet with Ethan and I, here locally if you want to come in, you want to do a phone, video, whatever works for you. So look forward to being able to help you that way also. On all of these shows, I like to start off the week, a summary of kind of what happened for the week within the stock market. So I'll share the chart here. And so we've been watching, this is going back to 2019. You can see the big drop there for the pandemic and then the big run up that happened. But if you look at what's happening here most recently, it's a pretty impressive actually. One of the things I like to look at is patterns, within the kind of the charts and the stock market and what have you. And the thing that's striking about this pattern as a whole is just how smooth really this run has been.
Yeah, the last 2 quarters have been super strong.
Yeah, and it's pretty rare. If you go back, you can see smooth to the downside, right? Because fear is a big, strong emotion. Yep. And so you look at that pandemic thing, that's pretty smooth. That went down 35% pretty fast. But if you look at just kind of, the other upturns, mostly there's a lot of, motion in there. The market tends to go up kind of slowly. So we're seeing a really strong market. And there's just so many indicators and so many pieces that are out there that are saying that this could continue also. We'll talk about some of those. But it's sort of just a momentum thing. What happens is, it's kind of like a big ship. Once it really gets up to full speed and it's going in one direction, it can turn the other direction. But it's very difficult, takes time and what have you too. So that's what kind of propels this. There's always something, that can come out of the blue, like, a geopolitical event or,
Yeah, there's always the black swan event.
Yeah, there's always something that can stop even a big ship that's moving like a torpedo, basically, right? I mean, so, but barring those, this market very likely will continue to do quite well for, the next 12 months even. And doesn't mean we won't have some pullbacks. I mean, last year we were up 26% and still had a 10% pullback, right? Yeah. We had 10% pullbacks in 2020, and we were up over 20% that year also. So that's not that unusual. I mean, partly in a really good year, the market just kind of is flying so much, it gets a little overstretched, comes back down, but the buying interest is still there, and it kind of takes off again. So, there might actually be a correlation there between those pullbacks and a good year. But, this is a combination of, first of all, the Federal Reserve talking about lowering rates instead of raising rates, inflation slowly but surely coming down. Okay, that's a big deal. The market loves lowering rates, right? It just does, because it means the cost of doing business gets cheaper, right, in essence. And so, profits can go up in those environments. We have a pent-up demand from the pandemic. Consumer sales came out today, and they were really good. January was down. They were blaming January on weather, so it seems like maybe that was accurate because February is back up again. And that's been the driving force all the way through here. We're supposed to have this huge recession last year. Didn't have it, really because the consumers out there spending, perhaps they have money left over from some of the stimulus things, but really I think it's more of just an attitude of kind of carpe diem,
Yeah, 70% of the GDP comes from American spending.
Yeah, and that's one thing Americans are really good at, even at the cost of credit card debt and what have you, which is kind of amazing. But you have other factors that are happening too. The government is spending, I read, $447 billion this year on infrastructure. From those infrastructure bills, So that's kind of stimulative to the economy. The job market is very sound. Wages are still growing at a decent rate compared to inflation, overall on a year-over-year basis. So that's nice. And, it just makes people feel like they have more. And so this is a really fantastic market. I have a chart here going back a little farther. So this has, going back to 1995. Let's take away the weekly summary thing so we can see. There we go. And you can see actually, and I'll put the arrows in here, kind of the last time we had this type of run, and this smooth, this steep, was 1995. And so those are some of the other factors that are factoring in here. We have the pent-up demand, kind of driving the market, and what Congress did to kind of save the economy. And then we also have this artificial intelligence, and this is not something that's made up or what have you. I mean, you look at NVIDIA's earnings, it was unbelievable. That really kind of blew me away. Up 486% on their earnings over a 1-year period.
Yep.
That's a big, big number. And when the earnings are actually going up more than the stock price, and the stock price is still up 200 and some odd percent, it's kind of amazing.
And the crazy part is they're not a small company either.
Nope.
It's not easy to generate revenue like that,
No.
that size.
No, I remember in the .com, it was Cisco was the picks and shovel type, piece that was coming in. But Cisco was fairly small at that time. They were kind of new with their routers, and you're exactly right. I mean, NVIDIA's been around for a long time, and they're not small at all. Matter of fact, now in terms of market capitalization, they're third on the S&P 500 and moving up actually, probably at the rate they're going. So, I think we're kind of sort of in the early innings of the 95, run that happened. And it was a fantastic move altogether. Again, the picks and shovel stuff will take off first, and then kind of the more, substantial IPOs. We saw Reddit come out, right?
Yep.
I think the IPO market's going to pick up. That's one of my predictions. It's been dormant for a long time. There's a lot of companies out there waiting, and they were jumped almost 50% their first day, and have continued to run also too. So, there's some hope there that starts to take off. We'll start to see artificial intelligence companies coming in, and it kind of, the rising tide will rise all boats, and you'll start to see this moving. I mean, this is the S&P 500 during the .com, which is predominantly dominated by big companies, and it still did really, really well. Ended up in the mania at the end, with the crazies, and that's what we have to watch for, and it ended up with a 45% downturn. Still higher than where it started, but the stock market is a representation of human emotion, and when you get a whole bunch of humans in a crowd, we can definitely go too far both ways. There's just the way it works, and you can't really stop it. You just ride it and just watch for the crazy stuff. I mean, at the end of the 2020, run, really end of 2021 in the end, that was the SPACs, right? There was, if you watch the SPACs, you got different celebrities that people are putting $1 billion into these pool of money that they then get to choose what to do with it. And, a few of those probably worked out, but a lot of them are gone or close to it. So, those are the types of things we want to watch for at that point in time. Now, this was actually a stat that a friend of mine who's in the business also, his name's Chad, he's in the Midwest. This is a relative strength index. This is a very well-watched index. I mean, Chad and I talk about this thing all the time. And it goes back a long time. This has been around forever. It was developed by a gentleman by the last name of Wilder, so Wilder's Relative Strength Index. And what happens here is that the shaded area is basically between 30 at the low end and 70 at the top end. So it goes technically from 0 to 100. But if it's below 30, it's considered stretched to the downside, might be a good buy, right? If it's above 70, and then it's considered stretched to the upside, might be a time to take some profits, or be careful of buying at that point, right? Oftentimes we are very careful with new money that comes in. We'll use this measure to maybe not buy when it's above 70, right? And you can see we had a tremendous run up there to basically, I think it went to 81 or something. But the stat that has come out was kind of discovered is that if you go back through the history of the stock market, when the RSI is above 50, and you can barely see it, but there's a little dotted line in the middle that represents 50. When it's above 50 for more than 80 days in a row, all right, trading days, this is a little over 100 now. It's only happened 6 times in the history of the stock market. And the 2-month, the 3-month, the 6-month, and the 12-month returns are all positive 100% of the time. after this event happens. So this is just another one. This is like the Zweig breath, indicator. This is, there's just one after another. We just had 2 quarters in a row that will double digits. That's only happened 5 times since 1950. These are things that we're starting to stack on top of each other that just show the power and the momentum of where it's going. And it also shows, and this is something I believe in wholeheartedly, momentum's important. So once you have it, you generally keep it for a while. And that's why I still say, we should be running for a while, unless there's just some really bizarre incidents. They happen, unfortunately. But, barring that, I think this market continues to go. But I thought this was a really interesting stat. And of course, today was the reporting for the PCE inflation index, right? So personal consumption expenditure price index, right? This is the favored measure for the Federal Reserve. This is the core version of that measure where they take out food and energy, which is what the Federal Reserve is looking at. And so we have CPI, right? Consumer Price Index, which is probably more well-known inflation indicator. They don't pay as much attention to that. And then we have PPI, which is the Producer Price Index, which is wholesale inflation. Those have already been reported. And so if you look at this, it came out today at 2.78% year over year. So versus last year at the same time. And still coming down. It was 2.85, last month. And so this is reported at the end of every month for the month prior. So this would be for March. And so they're going to get another reading before their next meeting, right before, because their next meeting is the 1st of May, right? And so they're going to get another PCE measure here. And again, target is 2%. And the reason that the Fed is talking about, lowering rates at some point is because they're starting to see this come down. You can see, the big jump in inflation that happened. As everybody started to come back out, the government put out a $1.9 trillion stimulus bill at that time too, which probably was contributory to this. And now we're unwinding that as labor gets back out there and supply starts to come in. It will be interesting to see, because we had that big, ship hitting the bridge in Baltimore. And see how that plays out, because that port's a really important port. Supply is important in an inflationary environment. So when you cut down on supply, I think there's like 800 and some odd thousand autos a year that go into that port, for example.
I think it's the #1 auto port. It's a relatively, I think it's the 17th biggest port in the U.S. So it's not, but it is #1 for the auto industry.
Yeah, and so I think they can get the port open a lot faster than build the bridge, of course, because they can just clear the bridge out of the way and the ships can start to get through there. But it'll be interesting to see what happens. We were talking to one of our clients yesterday, and he pointed out that they do use the bridge for transportation of, hazardous materials, which includes oil, and they don't go through the tunnels with those and such. So now they're going to have to figure out where that goes and how to make that work. So, all of these things, I don't know that it's big enough to cause a massive problem, but it is kind of interesting to see, what's happened there. So that's one of those kind of weird things that can happen that potentially has some impact. But if you look at, what we're having right now, the market is still expecting a rate cut in June. I think about a 65% chance of a rate cut in June. And so I still think that's early. And so do most of the Fed governors, actually, that get interviewed. Because I think they're looking at more of that second half. Another meeting, so we have May, no expectation for cut in May, right, for the market. June, expectation. July, expectation. I wouldn't be surprised if they don't wait till September to start cutting rates, because we keep seeing the numbers come in, and they're pretty good, all right? And so it's a presidential election year. It's generally a good year for the economy, for a variety of different reasons. But we're seeing, I think, inflation numbers that are maybe a little bit higher than you would really want. The month-over-month inflation numbers we were looking at today for PCE, it was 0.5% for January and 0.3% on the core PCE for February and March together. That's kind of high, right? I mean, it annualizes out to 4.8%, but it's a little seasonal, I think. So we'll see how this plays out for the year. But anyway, really fascinating time, a really good time to be in the market, actually. Excellent time to be in the market. The returns, for the S&P 500 are in the 11% range just in the first quarter this year.
Yeah.
That's a good number. So, we'll see how things play out for the rest of the year. Things are awful stretched out. On the RSI, which we just looked at, is around 67. So there's a little bit of room to move upward if it wanted to, in my opinion. But so it's not wildly stretched out. But still, it's amazing what's been going on. Every little dip. I've mentioned this in the daily videos. We've have now about 280 days, trading days, with no 2% drop on the S&P or more for the day. That's 280 days in a row. That's quite rare. The last time we had something like that was 2018. So we're starting to set some records there too. It's a fairly smooth move and very strong. And even the quarter rebalancing that we had this week, because we were down, for the first portion of this week. We have the rebalancing at the end of each quarter. These big target date funds, if they're supposed to be at 60% stock and they're at 65 because they had a good quarter of stock, they're going to sell that and buy bonds or buy international stock or buy whatever is lower than target. And so there's oftentimes a sell-off that happens at the end of the quarter. That didn't happen, this time very much. They were all like 0.3% drops and just not much. Again, showing the power of this market right now. So anyway, that's our summary for the week. Again, a very interesting time. It's a good time to be learning. It's a time to watch and see how this works, and be ready, identify these kind of clues. To me, I'm looking at this a lot as like the dot-com bubble, and expecting hot IPO market and crazy stuff happening at some point in the future, and we'll start to make some defensive moves as we start to see those things happening. But it's still a good time right now. This is the heart of it. This is probably a favorite portion of this type of move. All right. So anyway, that's it for this week. Look forward to covering this again next week. But let's go with our first question.
What has happened to the market in past election years?
Man, that is the most common asked question during my appointment. What do you think is going to happen with this election? Lots of concerns, about what might happen based on who wins. And I hear it from both sides, actually. People worried about Biden winning, people worried about Trump winning, because I have a broad spectrum of political, ideology within my practice, no doubt. Matter of fact, extremely broad. However, the president all by himself often doesn't have a huge impact on the economy per se. I don't know. There are some things you would say, okay, if the Democrats are in control of Congress and the White House, they might spend some more. You might have that problem with an inflationary time frame, right? That type of thing. On the other hand, if it's a Republican-controlled situation, you might see some tariffs on China, which, last time they went after tariffs on China was the end of 2018. The market dropped 20%. And the Fed was in the process of raising rates at the same time, both of which were slowing down the economy. So, the Fed ended up lowering rates in 2019 and things did okay. But ideally, we're looking at like what happens, in a normal year, right? So we have some stats to kind of show. And so here, this is done by BlackRock. This is an excellent piece here. Just going back to 1926, they're using kind of a large cap index from 26 to 1970. And then they're using the S&P 500 from there to now, at the end of 2023 anyway. And so the average return there is 10.3%, so that's something to keep in mind. If you're making more than 10%, which has been happening, we're higher than that this quarter.
Yeah.
Right. For the S&P. So that's pretty out of the norm, right? Presidential election years are higher, 11.6%, right? So on average, it's a good thing. Kind of fascinating, and we were talking about this earlier, midterm election years are lower by a fair amount, actually. And if we look at, non-election years, those are the best ones. So last year was a good one, and it has a little bubble there showing 26.3% for the S&P 500 last year, which is, way above average, of course. And it's kind of interesting to me. I guess it's just, there's no uncertainty, at least in an election cycle component, because there's no midterms, there's no presidential, and so their rate of return's higher. There are probably other factors that factor into there. But this is another chart that came out from American Century just showing, okay, what happens if during that midterm year, and it's down. So they show all the down ones here, 46, 62, including last, our last midterm cycle, 2022, down 18.1%, right? What happens during the election year a couple years later, right? 5.5, 16.5, 11.1, 23, all positive. Some of those numbers are actually pretty big and above average too. Matter of fact, there's 1, 2, 3, 4 or 5 of those that are above average. So that's the majority. And so again, here we are at 2024. We're already up 11%. We could give some of that back. The year's not over. There's all kinds of things that can happen there, but it is looking, positive. But the results for previous negative midterm years led to positive presidential election years. That's kind of the point here. So we have that going in our favor. Then you look at break the year into quarters. Kind of fascinating. So the first quarter, second quarter, historically are presidential years. They're actually less than the average quarter.
Yeah, they tend to underperform.
Yeah, now that didn't happen for us. We're up a lot this first quarter. There are some other impacts here. We have lowering inflation, lowering interest rates, artificial intelligence, etc. But the third quarter is the big one. So basically, as we go into the election itself, September, October, November, I have seen personally, I haven't done a study on this, but just my experience, the market jumps after the election, almost no matter who's in office. It certainly jumped the last time. It jumped in 2016, so it'll be interesting to see what happens.
Someone's always happy when.
Yeah, there is a group that's excited about what happens. Historically, the market actually likes a bifurcated scenario where you have the White House and Congress, some division. And the market doesn't do as well when the party is completely in control of both, House, Senate, and White House. And so, kind of depends on what that mix comes out to. The market likes stability, and it's because the companies like stability. They're investing, millions and billions of dollars in different projects. And, knowing that Congress can't get anything done, that probably helps with some of the clarity. So ironically, that, companies are looking at this, and that's why you see Wall Street do quite well there. And then, of course, what happens if it's a contested election, right? Because we've had a couple of these. So 2000, right, the Florida recount, the hanging chads, that went to the Supreme Court. And the market dropped, right? Prior to the election, during the contested period, and a month later, right? Yeah. That was a really big one, and it went through all the way to the Supreme Court. Now, if you look at what happened in 2020, it was contested in terms of, lots of court cases, but they were all over pretty quickly. It didn't go to the Supreme Court. And really, there was, I think out of the 60 that I remember happening in 2020 timeframe, there were only 59 of them were ruled against, and one was positive. So, I would think that if we have another contested election, it'll be a lot more like what happened in 2020 than what happened in 2000, personally. So, and obviously the market did fantastic, really went up a lot in that time frame. So it's kind of interesting as far as that goes. So, then the last thing is just, what happens with the Fed? Right? Because this is a big deal. The Fed, in my opinion, tries not to do anything because they don't want to impact the election. But they're lining up right now to do rate cuts they just did their dot plot, so they're going to do 3 rate cuts this year. Every interview keeps talking about the second half of the year, which is really the election time period. Maybe they squirrel some of them into the after election, to the later November or December timeframe, and maybe they only do one before. It kind of depends on what they can get away with. But there have been rate cuts and rate hikes historically, during an election year. And if you look at the numbers there, actually, they're all pretty positive. Now, this is for bonds, right? Different look, a different market. Still important to look at bonds. We have a lot of money in bonds here as a practice. But you look at those core bond returns, 7.5, 5.2, 3.6, 7.4, definitely better with rate cuts. So again, something to think about for you that have bond holdings that could be doing quite well here once the rates cuts really start also. But even during rate hikes, they did okay. 2.7, 4.3, and 11.6. So again, these are all kind of election year issues. What happens with what parties involved? Is it contested? What are the average rates of return? Which quarters do better? I think this is really interesting information. To me, this is all positive. I like presidential election years, at least from a stock market standpoint. Sometimes the ads get to be kind of irritating because they take over, but just that's personal. It's more just from a money making standpoint. I think that this is an okay thing altogether, and I'm not too worried about it. I'm much more concerned with what might happen with inflation. To me, that's there's geopolitical risk, there's all kinds of unknowns, but the one thing that I think is the most known is that inflation has been a little bit hot here for the last couple months, and this market is taking off and it's going really hot, and I think it can stay hot, and I think that could cause inflation itself to come back up or at least hold. And so that's where you got to be careful if you're the Federal Reserve, especially if they're going to start lowering rates. We don't want to see inflation coming back up again, because then they'll be going the opposite direction with rates, and the markets don't like that. So anyway, that's what's happening with that in the presidential election. Great question. And again, we put that in there because we've been getting asked it a lot within our clientele. All right, what's our next question?
How do trailing stop orders work, and what are the downsides for their use?
Yeah, I've been advocating the possibility of a trailing stop on NVIDIA, for example, just because it's been going so bananas, and at least taking some of your shares that represent some of your profits or whatever you might have, and putting a trailing stop. I'm looking at a 25% trailing stop. I don't really want to sell NVIDIA. I want to give it a little room, a lot of room. But I kind of look at it and think, hey, if NVIDIA's come down 25% already from its last high, and we'll show you a visual here of what that looks like, that, something might be wrong there, and maybe I want to take some of my profits off the table. So the way that it works, here's a nice visual actually. See, let's say you bought NVIDIA number 1 there, and you would put in a trailing stop, a 25% trailing stop.
Yeah.
What happens, the trailing stop is different than a regular stop. And a regular stop, if I put a stop in at number 1, it would stay there. It would move, right? A trailing stop moves. And so what it does is it locks in whenever there's a high. So if you look at point 2 there, basically, there was a new high, and boom, you end up with a new stop point. It moves up. So let's say you got $100, it goes to 110. You're going to be 25% below 110 instead of 25% below 100. And so it just keeps ratcheting up. So as NVIDIA runs and runs and runs, and goes through 1,000 or whatever it might do here, you continue to move that stop up, and then finally, you can see 0.5 there is where the trade, happened, where it actually executed. And you can see it stays flat every time it moves up. It doesn't go back. It doesn't go down to the new lows. It just locks in. So you're locking in, in this particular case, 25% from the high point for the high day, the close. They use the close here. So the highest close day that NVIDIA has, you would lock in at 25%. And if it finds a new high, you lock in another new stop that's a little bit higher, right? And so that's how it works. They're really nice, actually. I really like trailing stops just because, again, if it was still at number 1, you might have a 50 or 60% drop or 200% drop or whatever it is before. You can't get 200% drop. But, whatever it might be, it would still be at number 1. And so you can adjust those yourself and what have you, but the trailing stop just automatically does it. Again, there's some disadvantages. Right?
So if you have your trailing stop too close, you maybe get it might trade exit too early, in a sense that you miss a bounce up.
You can get just a whipsaw, right? You got a 10% trailing stop on something like NVIDIA. Well, that's a very fast-moving stock. It could easily
it could do that in a week easily.
Easy, and then take off from there, no problem. I mean, we've seen that actually a lot with that stock. So, you want to understand very closely and look at the motion of that particular. This can be done on an ETF or a slow boring stock or whatever you've got. it's not a bad way to kind of make sure that you're not really involved in a big downturn. Chances are, if there's something happening with your stock, it might be happening with the market itself too. So it just allows you to kind of lighten up some of your pieces. Now, for me, I'm kind of a long-term believer at this point in NVIDIA, so I wouldn't have all of my shares at a 25% stop. I'm looking at my profit. If I have 800 shares, maybe I'll do 200, because that's kind of my profit and that kind of thing. So, it just depends on, what's happening. But that really a good question.
So the Buffett indicator is currently sitting at near a 2-year high at nearly 190%. Is there any concern about this? The Buffett indicator is total stock market divided by annualized GDP.
Yeah, exactly. That's a pretty cool indicator. It's been around for a long time. Yeah, Buffett is a value player. He started out as a very, very deep value player, looking for companies that were worth more on their assets than their stock was worth. That type of thing. They moved into more of the they looked at more of the brand name value type scenarios. American Express, Apple, Pepsi, those types of things got huge holdings in those areas. And so this particular indicator is designed for them to say, hey, we don't really want to buy much here. And he'll wait. I remember once he had just massive amounts of cash because the market had run so much, and they're looking for some value and want to buy that. You're not going to find as much value in a market like this. Yeah, there is some concern, and ultimately that indicator works out. The only thing is, if you really study that indicator, you can have some pretty big runs for quite a while. Again, the market is a representation of human emotion. And when you get a bunch of humans in a crowd, they can go really far one way or another, right? And so you can get these, big run-ups, like the 2000 run-up, where, you might have been selling in 95 in the best 5 years of history stock market if you're using that indicator as your sole guide. To me, what it shows is that the market is stretched, right? And it is. But it can stretch and stretch and stretch. It's incredible. So I'd be more, it's sort of like the balance sheet. Here's the things that are positive about what's happening in this market. Here's the things that are negative about what's happening in this market. And I always have that, at least in my mind. And so the negative is the stretch. It's the part that, the two parts that scare me the most about this market is the stretch, just how far it's moved in such a short period of time. And then secondly, just this, potential for reinflating inflation, right? Because of the stretch of the market to a certain degree. And so to me, that's another measure, just like RSI, which we talked about earlier in the show, where the market can kind of get too far ahead of itself. And again, if you look at the 2000 run up, it ended up in a big downturn, right? Still ended up at a higher spot than where we started, but that's how it works. It goes too far, and then it comes back down. And so I think we're still going too far. To me, the Buffett indicator is just another piece of adding to the concern of being too stretched. And the beauty of our system with the way that we handle the money management is we have this big universe of ETFs, 180 some odd ETFs on there. And when things really start to fall apart, you'll see it. You'll see the more defensive ETFs that are on that list start to move to the top. It could be utilities or dividend-paying stocks or T-bills or whatever it is. And so you have plenty of time to kind of move, with that change as it happens. And that's how we deal with it. Now, we're never getting out at the top, or we don't believe in that. We like to see more erosion, and we really don't like to make a lot of changes as long as we're in a primary uptrend. And so I would take Buffett's gauge. I don't think he trades solely on it either. It's just part of the data, right? But I like the data. I would take it as part of the overall weighting of what you're going to do. And I would say at the moment that the momentum and the power of that momentum and all the stats behind that power of that momentum are outweighing my concern about being too stretched. Because in my career, I've seen markets get stretched way more than this.
So do you think it's a better buying indicator than a selling indicator? More of a good...
Oh, definitely, yeah.
Like use it for like,
on the
hey,
opposite
the market's
side.
cheap, I should get in now.
Yeah, definitely. Yeah, and that's his forte. He walks in 2008 when everything's going, he's got all that cash sitting on the sidelines, and he's in there buying J.P. Morgan and Citibank and some of these things, when they were selling it like $1 or $5 a share, and that's, he's a value player for the most part. And yeah, you're probably right, Easton. I would definitely think once that thing gets to the other side, where it's really showing an undervalued situation. Again, same thing, human emotion. Fear is super strong. We will run this market too far to the downside when it starts to come down. We did it in 2020. We did it in 1929. You name it, it's happened. And so there are periods of time where there are probably some profit potential, for buying low. I don't think that I would bet anything that indicator hasn't gotten real low for a while. Even with this 2022 downturn, it wasn't big enough probably to really get to a point where they're looking at serious value. One of the things that is happening is that the growth side of the equation is kind of pushing the value side aside to a large degree. And one thing that's different that I think changes the numbers a little bit is the amount of money in 401ks and the matches and all that. The cash flow, there's a cash flow engine that continues to grow year after year. Bigger and bigger amounts of money in 401ks and more cash flow coming in from 401ks. You go back 20, 30 years, and we use those type of data. We look back a long ways to try to see how would that indicator work. It didn't have this type of cash flow from 401ks, because 401ks, they weren't even exist. I remember Lockheed was very, very early here with a 401k, but really wasn't something that was being used very often. And now it's huge, right? So there are some things that can continue to push the market forward and kind of come in and buy, because people oftentimes don't change their 401k contributions. They might change their allocations, but even then they don't do that much, to be honest, from what we've seen. So I think it's an interesting area to take a look at altogether. But yeah, I think we're okay.
So what are golden handcuffs and how do they affect the real estate market?
Yeah, I just saw an article about this actually. What they're calling golden handcuffs. We usually associate golden handcuffs with like working for a company, and you have all these options. And you vest over 5 years, and you kind of want to leave for whatever reason or retire, and so it's like a golden hand.
They keep giving you stock options.
Yeah, it's a good problem to have, but it's still a handcuff for the person that wants to leave. And what's happening now in the real estate market is all of these low cost mortgages, right?
Never refinance.
Yeah, so if you're at 3% or 2 3/4 or what have you, and everybody managed to grab a bunch of those, if you want to move, well, you might have a capital gain, right? That's a problem. But let's say you don't. You still have this 2 3/4 loan, and you want to move, and you can't pay it off, so you end up with another mortgage wherever you're going. Now you're looking at, I don't know, 6 to 7, 7.5. I don't know the exact numbers right now. I haven't seen them in a little while, and so that's keeping people from moving. And so we've seen a little bit of growth in inventory just recently. Last month was up 10% over the previous month, but it's one of the things that's helping the real estate market as a whole is that the supply is depressed.
People don't want to sell.
No, they don't. And so it's kind of, those are historically low rates, right? And you'll never probably get them again. If you give up that loan to move somewhere and you still have to have a loan, you're going to have a much higher rate. Actually, probably right now we're closer to normal or average, right? So there's nothing particularly wrong with where we are now. It's just, I have a 2 3/4 mortgage, and, believe me, that factors into any thought process I have of moving, because I'm not going to get that. So that's pretty, that's what they're calling the golden handcuffs. I actually think it's a good thing for the real estate market. It's keeping supply down. If you're trying to buy a first home, you probably don't think it's a good thing. No. I'd like to see more supply come in, that's for sure. But we should have had a significant drop in real estate values when you go from mortgages at 3% to mortgages at 6 to 7, and we didn't, because the supply actually is still less than the demand, even though demand dropped.
Yeah, the supply is only coming on when people are building more houses.
Yes,
essentially.
I would think, and I was thinking about this the other day, I would think that this is a good thing for new home builders, because they are bringing on supply, right? And so they're not having to compete with all of these other people moving out of their existing homes,
Yeah.
right? So existing home sales could be depressed because of the lower rates, and then the new builders could be capturing some of that. However, they probably have a little offset because rates are higher.
Yeah,
So a little less people.
And they
can afford it.
usually build on a loan.
Yes, very much so. Yeah. No, it's a good question.
So, what's the efficient frontier?
All right. Let me see. We got a visual for this. I'll share it here. This was developed by Markowitz.
Yeah.
Is that right? At Stanford, won a Nobel Prize for some of this work. What you have here is a chart, right? So across the bottom here it says standard deviation. So standard deviation is a measurement of risk.
Mhm.
There's lots of different ones. It's one of them. And across the vertical axis there is expected return. And so what you would do is you would take every investment out there, all of them, every stock, every bond, and you would plot out its risk and its expected return. You can use expected as you can use actual returns also. It depends on how far back, but expected return is used basically using the capital asset pricing model, which is where they basically, because of the risk, it should make this much.
Yeah.
Essentially, right? It's a formula that uses beta as a measurement of risk, and so. But what happens is what they found was that when you plotted these out, and so you can see here's the individual assets, those little gold balls and such, and imagine that just filled with gold balls in every investment.
Yep.
And what happens is what they found, there's an edge, okay, and so the edge is the most efficient place to be. And so that could be just mixtures of portfolio, 5% stock, 10, 15, 20, 30, whatever it is, and you'll end up with an edge of kind of the most efficient. And what happens is anything below that edge. So if I looked at a dot that's in the middle of that little curve, if you look at that, it had the same standard deviation as the one that's up on the edge, right? But it had less return.
Yep. You're taking on the same risk. For
Yeah,
less
same
return.
risk, less return. What you want is the most return you can get for the risk that you are taking. Those portfolios are on the efficient frontier.
And you can kind of see how returns diminish even though you take on more and more risk. It's
Yes.
not a linear.
Yeah. And so what they're talking about, this tangency portfolio, essentially the way I look at that is the ultimate one is that corner up there in the top. So you'd have no risk and all return, right?
Yep.
It doesn't exist, but that's the best you could possibly have. So when you create this efficient frontier and you get all of these holdings and you get this curve, the one that's the closest to that corner is the most efficient.
Yeah,
It may not have the highest return, but for every unit of risk, you're making the most return.
Yeah.
And oftentimes that tends to be kind of in that 60-40 portfolio. When you do portfolio mixtures, it's why you hear about 60-40 all the time. It came from this work, because it's the one that's pretty close to that corner up there. Now, you can have an 80% portfolio and 20% stock, 20% bond. You'll be farther up and you'll actually have a higher rate of return, but you're taking on more risk. And your unit of risk is higher per unit of return, if that makes sense. Doesn't mean that a lot of people have 80% portfolios in our practice, and that's fine. It's not the most efficient, in terms of overall, but if you're on the efficient frontier with that 80%, you're making, more money than you are with a 60% portfolio over the long term. And, you just have to accept the risk.
Yeah.
We have lots of clients that are accepting the risk. And so anyway, that's how that works. It's very fascinating. I've done a lot of work in the efficient frontier. Morningstar has a really good software package that we've run the efficient frontier on. It's a very fascinating piece. I've always kind of enjoyed it, but that's how it works.
Should I rebalance my equity portion? It started out 60-40, but has shifted to 70-30 over the last couple of years.
Okay, so that question comes up fairly frequently also. It's a little bit controversial, to be honest. I mean, people will say, well, if I'm rebalancing, I'm selling my winner. In his case, the stocks have won. They're up 10% more and the bonds are down 10%. So it kind of depends on the situation. Number one, your risk just went up. right? So you bought a 60-40 portfolio, and now it's 70-30, right? Stock bond. And so you have more risk in that portfolio. In a good market, that's a good thing.
Yeah, you want that extra alpha.
Right. In a bad market, it's a bad thing. So what you really want to do, I think, is really identify long-term what mixture you can live with. So if you start off as 60-40, and that's the one that you identified, you looked at all the data and you said, okay, I've seen how much this drops, and that's as much as I want it to drop, you know, and I could handle that, but anything more, I don't want to go there. Well, now your portfolio has gone there, right? You're now in the 70%. So rebalancing, partially, the thought process should be about the risk tolerance that you have.
Yeah.
And so if you look long-term at a 70-30 mixture and you are comfortable with that, then at least for that point, you're okay, right? However, there are some studies that show that rebalancing annually, let me share one with you here that came out of Forbes, can do quite well, actually. So this is actually a very fascinating little slide here. You got $10,000 over 25 years.
Yeah, they both started at 60-40, which is the S&P 500 and the Barclay Bond Index.
That's right, exactly. And so pretty simple, two-piece portfolio. And you can see actually the chart that's on the lower part shows how much was in stocks versus bonds. And so the dark blue or black or whatever that color looks like to you is the rebalanced portfolio. And then kind of the orange is the non-rebalanced. Just left it 60-40 and let it go.
Yeah, and they rebalance annually.
Right.
It looks towards the end of the year.
Right, exactly. And so if you look, first of all, the one that's not rebalanced had a higher value, the peak value there in 2000, right?
Yeah.
Top of that best 5 years in the history of the stock market. We're kind of running into something like that now, possibly, right? It was worth 77,000 versus 72,000, right? So you would say, at least in that time period, that you're better off not being, rebalancing at all. You have more money. But if you look at like the big downturns that happened here, so 2008 is that big downturn, there's less drawdown. It's down 29.98 versus 37.08, right? So that, again, what happened was you just shifted the risk. You got higher percentage. It looks like it got up to about 80% stock at one point.
Yep.
And prior to the 2000, it was maybe 75, 2008 downturn, probably 75% versus 60. So, you're going to have less downturn because of that. And in the end, after a couple of cycles and rebalancing once a year, you ended up with more money in the rebalanced portfolio. I think this study's the way to look at it. Because if you're just looking, if you're a day trader, or if you're looking at, something for a year, 5 years, you've got to look at other things besides rebalancing as a way to kind of improve returns, because you really need the full cycles. You need those kind of ups and downs. And that's when rebalancing, I think, really kind of pays off, because in some cases you're rebalancing at some low point and you're buying stock, right? And so I know BlackRock did a big study saying that really rebalancing works best if you're not going to do it on an annual basis when things are 5% out of whack. So if you get to 65% stock, then you'd rebalance back and just let it go until it gets to 65 again, or vice versa. If the bond portion became 45%, then you'd rebalance back to 40 and buy some stock. And so I think both of those are decent strategies. It's kind of fascinating how these work, and it's a really good question as far as that goes. So, all right. All right, well, that's our show for today. Some good questions, actually. Hopefully this helped everybody to get farther down the road. Send in some more questions. We got some live questions today. That's fantastic. Come next week, put in some more live questions. Those are fun. It gives us puts us on the hot seat. And then secondly is just send them during the week. Give some time to, which is a lot of these come from our client reviews, or we get these questions during the week. It gives us a chance to go find a chart or something, kind of make our point as far as that goes. And so, of course, you can subscribe to our channel. Really good resource, I think, for retirement planning. And then lastly, if you want to, you can meet with Ethan and I. Hit the book appointment button and set up a time to meet with us. So thank you, everybody, for coming today. Really appreciate that, and looking forward to seeing you again next week.